Hi there, welcome to Kneppy Invests. Time to do a Fenix update looking at their quarterly report for the December quarter. And I think it's fair to say this quarterly report did disappoint. We saw a brutal reaction from the market. If I remember correctly, the share price was down something like 20 or 25% on the back of this. The market should have expected bad results because this company is an iron ore producer and the price of iron ore was at its lowest during this quarter. But I think the market, and in fact, if I was being honest myself, was not expecting this sort of result. Operational cash flow negative by $11 million, and this was significantly worse than the previous two quarters. And I did think it put a little bit of dent in the way market thinks about this company. So in this video, I'm going to go through the quarterly report, but things are looking a little bit more bright for Fenix as the iron ore price goes up. But again, the share price of Fenix and the performance of Fenix is almost 100% correlated to the price of iron ore. Fenix is an iron ore producer. They've only been in production for about a year or so. Founded in 2007, listed on the ASX 2008 via Emergent Resources. So Fenix itself hasn't been on the ASX for 13 or 14 years. So companies can change. Sometimes, particularly those exploring mining companies, aren't successful, and then they become some other company, and that's the route Fenix took to become an ASX listed company. The managing director is Robert Brearley. He's been in that role since March 2019, and the market cap of this company at 25 cents is $118 million. You'll have to look at that market cap because it is dependent on the share price. It can go up or down depending on the price of iron ore. And the ticker for Fenix is FEX. One of the reasons Fenix came onto my radar was just some of their financial year 21 numbers. Now keep in mind, this is the first half of the calendar year when the price of iron ore was at its highest. And this is the period where we would expect Fenix to be performing at its best. And when you look at these financial year 21 numbers, it's only half year numbers because they went into production almost 1 year ago. Revenue of 114 million, operating cash flow 65, profit after tax 49, had $68 million of net cash, spent $24 million of capital expenditure, but the enterprise value was around 50. And when you look at some of the valuation metrics, they do seem quite low. EV to operating cash flow 0.8 and PE ratio 2.4. But the market was knowing that because iron ore prices were pretty sky high at this point in time, Fenix financial numbers should look really good. But the question becomes, when eventually the iron ore prices would fall, how would Fenix perform during those periods? Because unlike Fortescue, Rio Tinto, BHP, the costs Fenix have to spend to get the iron ore out of the ground is significantly higher than those companies. And in fact, there was one company that completely shut down their iron ore production because iron ore prices were lower than the cost it took for that company to get it out of the ground. They've gone back into production now because iron ore prices have risen. But just keep that in the back of your mind when you are thinking about taking a position in Fenix or one of these other junior iron ore producers, is the cost they spend to get the iron ore out of the ground is higher than those bigger companies. And if the iron ore prices come back or pull back a fair bit, these companies will be way more affected than those other big companies like Fortescue, PHP, and Rio. Now let's have a look at the activities report before we have a look at the cash flow statement. And the main things I want to look at in the production summary and performance at a glance is the C1 cash costs. That's the main thing I'm looking at, the production summary. And that was 94.1 Australian dollars per wet metric ton. I'm also looking at the price they received from the iron ore, which was 109.6. But there were some offsets to that, so they actually got less than at 109.6, and that's one of the reasons why they were operational cash flow negative. Before we have a look at the December quarter operational cash flow, I just want to go back to the September quarter because you can, just so we can compare how much the lower iron ore prices affected Fenix. So in this particular quarter, receipts to customers 71.8 million, and they were operational cash flow positive by 25.4 million. And this result was actually a little bit worse than the June quarter. June quarter was an absolutely stellar quarter for Fenix, because that was a quarter where they experienced the higher prices for iron ore, something like $200 per wet metric ton. During the September quarter, something like $160, and in the December quarter, down to $100. So again, the performance of Fenix is almost perfectly correlated to the price of iron ore. In this particular quarter, they spent $1.5 million on capital expenditure, began the quarter with $69 million on cash, finished the quarter with $93 million. So that means the enterprise value at this point in time was $25 million. They also decided to give a dividend to the shareholders, and that dividend amounted to $24.8. But that dividend was going to be paid in the December quarter. So let's see how the lower iron ore prices and the dividend they did pay out affected Fenix and their cash on hand. So remember, in the September quarter, they received something like $74 million in receipts. This particular quarter, with lower iron ore prices and even possibly lower production, receipts to customers only $34.1 million, which was significantly lower than the production costs, which were $44.5 million, which means Fenix was operational cash flow negative in this quarter by $11.1 million. And I do think this surprised the market, and that's why the share price was absolutely punished on the day Fenix released this report. They also spent $3.5 million on capital expenditure, $24.8 million on dividend. Thus, cash on hand fell from $93 million to $54.9 million, and the current enterprise value of this company is sitting at $70 million, which is a little bit more than what we saw at the end of the September quarter. But in saying all that, things are looking a little bit more bullish for Fenix, simply because iron ore prices are going up. And there was a bit of commentary in their quarter report that I think this was from the managing director, and he said the current quarter has started positively with higher iron ore prices and lower freight rates. That's something I didn't mention. They did experience higher freight rates than usual, and the high likelihood that pricing adjustments will result in cash inflows. That's something else they did in the December quarter. There was some pricing adjustments. I'm not absolutely sure why that happened, and because of these pricing adjustments, it did affect their operational cash flow, that sort of thing. So all these things that led to operational cash flow negative quarter, looks like those things are turning positive for Fenix, and it is mentioned in this piece of commentary that they do expect cash inflows in the current quarter. Now, there might be some out there who don't believe that the Fenix share price is highly correlated, if not perfectly correlated. I wouldn't say perfectly correlated, but definitely highly correlated to the price of iron ore. And to really show this, what I've done in this graph or this chart is to overlay the price of iron ore onto the Fenix share price chart. This goes back to the end of 2020, and the Fenix daily chart is just the candlesticks, and the iron ore prices is that solid black line. And there is a pretty good correlation between the two, almost perfect correlation. And you can see the price of iron ore reached a high in the middle of 2021, and that's when the share price of Fenix reached a high. And as soon as iron ore prices started to fall, the Fenix share price started to fall, and as soon as the iron ore prices started to rise, that's when the Fenix share price started to rise, until we saw Fenix release their quarter report. That's where we did see the share price drop 25 or 20%. But iron ore prices continued to rise, and Fenix share price continued to rise then, until just recently, where we did see the iron ore prices drop a little bit. And during that little bit of a drop in the iron ore prices, we saw the Fenix share price drop. Who would have thought of that? So again, Fenix share price is and performance is highly correlated to iron ore prices. So if you are bullish on iron ore for the future over the next 1 year, 2 years, 5 years, then companies like Fenix, Fortescue, BHP, Rio are the sort of companies you might want to buy in. I have no idea about the future of iron ore prices, and in fact, I believe no one does know. It's just at the whims of supply and demand. So really, Fenix share price could go up or down from here. And the last thing I want to show you here is the iron ore prices in candlesticks. So this is 1 day iron ore prices. And I've also shown you where the December quarter lay for for not only Fenix but also other iron ore producers. And during that period, we did see iron ore prices bottom. In fact, it was almost in the middle of the December quarter, all the way down to about $88 per wet metric ton, or per ton, whatever it is shown. And then as soon as we hit that bottom towards the middle of November, the price of iron ore has gone up. So definitely the December quarter was going to be the worst performing quarter for Fenix, unless we see a dramatic fall in iron ore prices moving forward. But at this point in time, we are more than halfway through the March quarter, and iron ore prices have been significantly higher than the previous quarter, particularly when you look at the average. So without doubt, at this point in time, on February the 18th, the performance of Fenix in the March quarter will be significantly better than what we saw in the December quarter. That's all I have for this December quarter report video for Fenix. This is an iron ore producer. They are a price taker. In fact, I did see one presentation from a miner who showed the costs of the business, and they actually separated the costs of the business into uncontrollable costs to controllable costs. And that uncontrollable cost is a feature of a lot of mining companies. They don't control a lot of their costs, and they don't control a lot of the prices they get from selling the commodity they actually do mine. So that's something you have to be aware of in any sort of mining. They are price takers. A lot of investors prefer to invest in price makers. But I do find sometimes you can find a lot of value in mining companies because it's very cyclical, and when the commodity they're mining is at the bottom of the cycle, that's almost the ideal time to take a position in a mining company, and returns can be quite good. I do also believe that mining companies are not long-term holds or buys, so you'll never buy into a mining company like BHP and just hold it forever. You always trade this cycle. That is just my opinion. Some people out there might think owning Woodside, BHP, Rare for the long term is the best investing strategy for them. So if you do want any questions or me to answer any questions, leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you are or do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs.